If you woke up this morning thinking the world feels a little strange, you're not wrong. Something quiet shifted in the global financial system. Not the kind of shift you can see on the surface, more like a vibration underneath the floorboards. The kind you only notice when the glass on the table starts to tremble. And if you listen closely, you'll hear where that vibration started. Not in New York, not in London, but in Tokyo. For most people, a rising yield in Japan means nothing. Just another number floating across a news ticker. But numbers are stories, and some stories change everything. The number that appeared was small, just a few percent, but inside that number lived a warning, a reminder that even the quietest giants can wake up angry. Japan has been the silent engine behind global money for more than 3 decades. Not the loud engine, not the showy one covered in chrome, more like the old, dependable machine humming in the back room, the one no one thinks about, because it has never broken down. But every machine has limits. For years, Japan kept interest rates so low they were practically a dare. Borrow here, invest elsewhere, pocket the difference. It was the easiest financial trick in the modern era. Global investors fed on it. Entire strategies grew around it. Some fortunes were built on nothing more than the echo of Japan's cheap money. Inside the transcript, you saw hints of this story: the borrowing, the ultra-low rates, the enormous debt, the fragile balance Japan was forced to maintain. But the transcript only shows the surface. Beneath it is the deeper lesson that affects every person watching this channel, whether you live in Hanoi, Saigon, Helsinki, or anywhere else on Earth. Cheap money created the world we know. Rising money will create the world that's coming next. Here's the part most people miss. When interest rates rise in a country like Japan, the effect doesn't stay inside its borders. It leaks, it seeps, it rolls across continents like a slow-moving tide. And that tide eventually reaches your savings account, your mortgage, your investments, your plans, your dreams. When you zoom out far enough, financial systems stop looking like numbers and start looking like weather. And something in the global weather system is shifting. Imagine a giant tree in the middle of a forest. It's old. It's steady. Everyone around it has grown used to its shade. Investors built houses around it. Businesses planted roots near it. And then one morning, that tree begins to lean. Not fall, just lean. Most animals in the forest don't notice yet. But the smart ones, the ones that survive winter after winter, they lift their heads, because big trees don't lean for no reason. Japan has reached a point where every choice hurts. The transcript described this dilemma as two doors, both dangerous in their own way: raise rates and risk a debt delosed, or keep rates low and let the currency weaken, squeezing households and raising inflation. This is one of those moments where you realize just how fragile the world can be. Not fragile like glass, fragile like ice. It holds your weight until the moment it doesn't. But here's the part that matters for us on the passive path. Every shift in global money creates winners and losers. Every storm reveals who built a shelter and who built a sandcastle. People often imagine financial shocks as sudden explosions, but most aren't. Most begin as whispers. A quiet number moves, a policy changes slightly, a yield rises, a currency flinches. Nothing dramatic, nothing chaotic, not at first. Then pressure builds in places no one is watching. This is how change works. Quietly, patiently, and then all at once. Let's slow down for a second. Let's breathe, because the point of this story isn't fear, it's clarity. The passive path is built on one idea. When the world shakes, the people who understand the story suffer less than the people who ignore it. Not because they predict the future, but because they prepare for the parts of the future that are already in motion. Cheap money encouraged the world to sprint. Expensive money forces the world to walk. Cheap money rewarded risk. Expensive money punishes impatience. Cheap money lifted every asset together. Expensive money separates the real from the imaginary. And that's the shift we're living through now. You're going to see markets move in ways that felt confusing. Assets that once felt invincible will start acting tired. Businesses that relied on borrowing to grow will suddenly feel heavy. Investors who thought they were geniuses in 2021 will realize they were swimming with a current they never saw. This is the part of the movie where the lighting changes, not the climax, not the panic, but the scene where the tone darkens and the audience leans in a little closer. I want you to notice the tone. Notice the direction of the wind. Notice the way money is beginning to behave differently. Because while the transcript paints a picture of geopolitical pressure, rising yields, and the unwinding of global carry trades, transcript, our job is to translate that into something personal, something human, something useful. Money is not just a global system, it's a personal ecosystem. When a massive current shifts, it doesn't matter whether you're a billionaire hedge fund manager or a quiet saver who buys index funds once a month. The current still reaches you. And here's the question that will follow us through this entire video. When the world transitions from free money to priced money, what kind of person do you become? I'll tell you a story, a simple one. Imagine two travelers on a mountain. One spent the last decade walking on smooth stone. No obstacles, no surprises. Every step felt like progress. That traveler became fast, confident, maybe a little careless. The other traveler walked on uneven ground. The stones moved, the wind shifted, progress was slow. That traveler learned to balance, to listen, to steady themselves. When the weather changes, which traveler survives? The fast one or the steady one? This is where we begin our journey tonight. Not in panic, but in awareness. In the understanding that money has a rhythm, and that rhythm is changing. Cheap money made the world sprint. Priced money will make the world think. And if you can learn to think clearly while others are still trying to sprint, you win without running. When a system like Japan begins to shift, the change doesn't travel in a straight line. It moves like a wave. Not a single crest, but a series of pulses, each one stronger than the one before it. And the first pulse usually hits the people who believe they're safest. For decades, investors used Japan's cheap money as a hidden engine. They borrowed in yen, paid almost nothing in interest, and poured that money into assets everywhere else. Tech stocks, real estate, crypto, emerging markets, safe bonds, risky bonds. Anything that could rise if someone poured enough fuel under it. The transcript described this borrowing strategy as a carry trade, a structure built on low Japanese rates and high global returns. But behind that strategy is a story about human nature. People confuse stability with permanence. They assume conditions that lasted 30 years will last 30 more. They build entire lives on that assumption. Every financial bubble has a villain, but the villain is rarely a person. Most of the time, it's comfort. Comfort blinds you to quiet danger. Comfort makes you think you're smarter than you are. Comfort whispers that a rising market is proof of your genius. Then the wind changes. When Japan's yields rise, the money borrowed cheaply begins to lose its footing. Investors who owe yen suddenly realize the ground beneath them has shifted. Their borrowing costs climb, their profits shrink, their currency exposure turns against them, and one by one, they start selling what's easiest to sell. This part matters. They don't start by selling the weak assets. They start by selling the strong ones, not because they want to, because they have to. When pressure hits, investors liquidate whatever can be sold quickly. The liquid assets, the popular assets, the things that everyone wants during normal times. That means large tech stocks, major indexes, gold, and sometimes crypto. It's not personal, it's mechanical. A global margin call doesn't ask what you like. It asks what you can sell. That's why you'll often see the strongest markets fall first when stress enters the system. Strength becomes a target simply because it's easy to convert into cash. Picture a traveler crossing a narrow bridge with a heavy backpack. If the rope snaps, the traveler doesn't toss away the useless items first. They toss whatever is easiest to throw. Survival doesn't care about sentiment. This is the hidden rule of financial storms. Pressure forces clarity. Clarity forces action. The transcript mentioned the possibility of sudden drops in major markets when Japan makes even small policy shifts. But what matters for you isn't the prediction, it's the mindset. You don't need to guess the exact day the wind will change. You only need to understand what kind of traveler you want to be when it does. There's another layer to this story, a part most people never consider. When cheap money disappears, time becomes expensive again. Think about that. For the past decade, time was practically free. Companies could lose money for years and still be celebrated. Investors could buy assets with no cash flow and still feel wise. Debt felt light. Risk felt soft. The future felt guaranteed. Now imagine that same world with time priced at a premium. Imagine every delay costing more. Imagine every mistake compounding faster. Imagine every dollar borrowed becoming heavier. This shift doesn't punish everyone equally. It rewards people who learned patience earlier. It rewards businesses that generate real cash. It rewards households that avoid unnecessary debt. It rewards investors who can sit still while others panic. You don't need to outsmart the market. You only need to survive the parts where everyone else forgets the basics. There's a saying whispered among old sailors: the storm doesn't choose who survives. It only reveals who prepared. Money works the same way. And here's the quiet truth buried inside this entire situation. Japan's shift is not the cause. It's the trigger. The global system has been stretched for a long time. High leverage, high expectation, high valuations built on the assumption that money would stay cheap forever. When the foundation shifts, everything built on that foundation feels the tremor. But tremors don't exist to scare you. They exist to wake you up. We live in a world where many investors grew up during the age of free money, a world where index funds always seemed to rise, where housing always felt safe, where borrowing felt like opportunity instead of risk, a world where even bad ideas could survive if given enough funding. But we are entering a different chapter now, a chapter where the cost of money shapes everything, a chapter where risk finally has a price, a chapter where the market stops rewarding speed and starts rewarding discipline. And that brings us to a question most people avoid because it forces them to face themselves. What happens to your financial life when the world stops giving out free momentum? Your habits become your leverage, your discipline becomes your edge, your patience becomes your advantage, your clarity becomes your shield. The passive path is not about predicting earthquakes. It's about building a life that doesn't collapse when one happens. That begins with a simple mindset shift. Stop trying to chase the wind. Start trying to anchor your ship. The transcript spoke of rising borrowing costs, political pressure, and the possibility of global liquidity reversing course toward Japan. Those are real forces. But beneath them lies the simple truth that money behaves differently when fear enters the system. Fear shortens time horizons. Fear accelerates selling. Fear exposes fragility. Fear reminds everyone that the future isn't owed to them. But if you can stay calm while others shorten their timelines, you create space. You create clarity. You create the chance to make decisions that compound quietly for years. You don't need the world to be peaceful to build wealth. You only need to stop acting like chaos is a surprise. More in the next part. When global money tightens, the world reveals its true shape. You start to see which systems were propped up by hope, which companies survived on borrowed time, and which families built their financial lives on sand instead of stone. You also start to see something else, a pattern that appears in every major shift, a pattern older than markets, older than currencies, older than nations. When the environment changes, the creatures that adapt are the ones that make it through. For decades, the environment was soft, easy credit, low rates, endless liquidity. The system kept pumping oxygen into every corner of the economy, keeping even the weakest ideas alive. If a business struggled, someone lent it more money. If a market dipped, someone printed more currency. If a valuation made no sense, people shrugged and said the same phrase every bubble repeats: this time is different. But the air is thinner now, and weak lungs always struggle first. The transcript talked about Japan reaching the limits of its long experiment with cheap money, an experiment that fed markets around the world for more than 30 years. But the deeper story is what happens when a global habit breaks. Cheap money created a world full of shortcuts. Expensive money brings back the long path. Cheap money rewarded aggression. Expensive money rewards endurance. Cheap money covered mistakes. Expensive money exposes them. And that shift affects far more than markets. It affects behavior. People who once believed debt was harmless will start to feel the weight of each payment. Investors who believed every dip was an opportunity will face stretches where dips keep dipping. Businesses that relied on constant funding will discover what happens when the funding stops. This is the part of the cycle where illusions evaporate. And it always happens slowly at first. You'll hear it in conversations. A friend mentioning their mortgage renewal with a nervous laugh. A colleague wondering if their company can survive another year. A neighbor quietly selling assets they once swore they'd never touch. These aren't signs of collapse. They're signs of awakening. When money becomes more expensive, people become more honest about their decisions. They start asking questions they avoided for years. Questions like, what do I actually own? Why did I buy it? Can it survive a tougher environment? Does it produce anything real? Does it make my life better or heavier? Those questions are uncomfortable, but they are the foundation of financial adulthood. The transcript warned that global markets could face rapid sell-offs when liquidity drains out of the system, especially from investors unwinding their yen-based positions. That's a real possibility. But the more important lesson is what happens inside you when the world stops handing out effortless returns. Some people retreat, some panic, some freeze, some gamble even harder. But a small percentage of people shift into something wiser, something steadier, something that doesn't depend on prediction. That small group learns to prepare instead of react. Preparation isn't glamorous. It doesn't show up in headlines. It doesn't get applause. But it's the reason why certain families stay afloat across generations, while others rise fast and fall even faster. Preparation looks quiet on the outside. A little more cash on hand, a little less debt, a little more patience, a little less ego. But inside that quietness lives strength. Imagine a forest in late summer. Most trees look green and healthy, but the ones that survive winter aren't necessarily the tallest or the most beautiful. They're the ones with deep roots, hidden roots. Roots that weren't obvious during the warm months, when everything looked successful. Money works the same way. Growth is flashy, roots are silent, but only one of them keeps you alive when the season changes. The transcript hinted at the possibility of global liquidity flowing back to Japan as investors unwind positions, a reversal that could tighten conditions everywhere else. That scenario is less about predicting a single event and more about preparing for an age where global conditions feel heavier than the decade before. Heavier doesn't mean hopeless, it means intentional. It means you can no longer rely on the wind to push you forward. You have to row your own boat. And rowing does something strange to people. It humbles them, it slows them, it strengthens them, it teaches them to appreciate distance instead of speed. This is the environment where real wealth is built. Not the kind of wealth that impresses strangers, the kind that builds security, options, freedom, space to breathe, space to think, space to wait for the right moment instead of chasing every moment. This next phase of the script takes us deeper into what happens when the system forces discipline on a world that forgot what discipline feels like. When a financial system is forced to swallow higher interest rates, every hidden imbalance rises to the surface. Not instantly, not dramatically, but inevitably. It's like lowering the water level in a harbor. Boats that once floated confidently begin to scrape against rocks they never knew were there. Households feel it first, then companies, then governments, then markets. The transcript described Japan's government facing rising debt costs and pressure from both financial markets and geopolitical forces. But behind those details is a quieter truth that touches everyone. When the cost of money rises, the margin for error shrinks. A family with a mortgage feels tightening first, higher payments, slower progress. A clearer understanding of what they can and cannot afford. That clarity cuts through denial. It forces choices that were easy to postpone during the cheap money era. Should we keep this house? Should we renew the car loan? Should we take on new debt? Should we wait before investing more? These questions don't appear because people became more cautious. They appear because the environment stopped forgiving carelessness. Businesses feel the same pressure. Companies that relied on constant borrowing start to confront their real strength. Those that survived because money was cheap discover the limits of their model. Those built on real value find a strange advantage. The world finally recognizes the worth of things that produce actual cash. And then there are governments. Heavy debt becomes heavier. Interest payments crowd out public spending. Political leaders face a familiar trade-off: protect the currency or protect growth. But protecting one often damages the other. The transcript highlighted this dilemma in Japan, where even a small rise in rates magnifies the cost of servicing enormous debt levels. But the deeper lesson isn't about Japan. It's about what happens when a society reaches the point where every dollar must be justified. Easy money softens accountability, expensive money forces it back. This shift is uncomfortable, but discomfort isn't always danger. Sometimes discomfort is instruction. It teaches societies, businesses, and households to rebuild muscles that atrophied during the age of abundance. Patience, discipline, selective risk, real savings, clear priorities. Those traits don't sound exciting, but they shape long-term resilience. The transcript described how global investors might retreat from risky assets to cover yen obligations, potentially dragging down markets worldwide. That process repeats throughout history whenever liquidity reverses, but you don't need to fear it. You need to understand what it reveals. When fast money leaves, real value becomes visible. In a world of rising rates, weak investments struggle to survive. Strong investments slow down but stay intact. Investors who relied on hype fall silent. Investors who relied on fundamentals stay calm. That calmness is not a personality trait. It's the result of structure, a life built with buffers, a portfolio built with patience, a plan built with margin for error. People often imagine wealthy individuals as fortune tellers. But true wealth doesn't come from predicting the future. It comes from being prepared for a range of futures. Imagine two archers. One uses a bow made of thin, brittle wood because it's light and fast. The other carries a heavier bow, slower to use but reliable under pressure. When the wind is still, both archers hit their mark. When the wind shifts, only one keeps control. That's the position many people will find themselves in as global money titans. Those who built their financial lives during the easy years will feel the wind first. Those who quietly practice discipline will find their footing faster. This is not punishment. It is recalibration, a world returning to balance after a long era of extremes. And here's something few people admit. Balance often feels harsh when you've lived in imbalance for too long. If markets fall, that is not imbalance. If debt becomes expensive, that is not imbalance. If businesses fail when funding stops, that is not imbalance. These are normal consequences, returning after a decade where consequences were delayed. But delayed consequences don't disappear. They accumulate, they wait, they arrive all at once when the environment no longer protects you. This is why understanding global shifts matters, even if they seem distant. When a country as large and influential as Japan adjusts its policies, the ripple touches everything built on borrowed money, and almost every modern financial system has been built on borrowed money. The next part of this script will step deeper into what this transition means for individual investors, for ordinary savers, and for anyone trying to navigate the next decade without losing their footing. When a financial cycle turns, most people look at charts. They watch indexes, currencies, yields, and headlines. But the real shift happens long before any chart shows it. It happens in behavior. People stop assuming tomorrow will look like yesterday. They stop spending without thinking. They stop treating growth as a guarantee. They stop believing debt is harmless. The transcript warned that higher global rates could reset the way assets are valued, from housing to stocks to entire business models. But the deeper message is that rising rates change how people move through the world. You see it in the way conversations tighten, in the way optimism becomes cautious, in the way people look at their budgets with new eyes, in the way investors suddenly rediscover the meaning of patience. This is the first sign of transition. People shift from chasing returns to protecting stability. Protection isn't fear. Protection is awareness. It's the moment you realize the wind has changed and you adjust your sails instead of pretending the ocean is calm. The next sign appears in businesses. Companies that once expanded without hesitation begin to slow their hiring. They reconsider new projects. They evaluate their costs with sharper focus. They look for ways to survive rather than ways to impress. During the cheap money era, many companies grew simply because money was flowing everywhere. Cash was easy to borrow, investors demanded speed over wisdom, and the market rewarded boldness over durability. But as rates rise, the world redistributes power. The advantage shifts from fast companies to stable ones, from ambitious companies to cash-flowing ones, from high-risk ideas to grounded strategies. This reversal isn't new. It happens in every tightening cycle, but each generation experiences it for the first time. The transcript described how global investors might sell their most valuable assets to repay yen-based obligations, but for individuals, the same psychology appears in smaller ways. A family might sell a second property to reduce debt. Someone might withdraw investments earlier than planned to create breathing room. Someone else might stop taking financial risks altogether because the environment feels heavier than before. Financial tightening makes people honest. It strips away the illusions created during easy times. It reveals the truth about what you actually own, what you actually need, and what you actually believe. And in that clarity, something powerful appears. Resilience. Resilience grows in the space where illusions die. Resilience begins the moment you stop hoping for the world you wanted and start preparing for the world you live in. A rising rate world rewards resilience more than brilliance. It rewards long-term thinking more than short-term excitement. It rewards structure more than spontaneity, and it creates opportunities for those who still have calm hands when others are shaking. Imagine a long hallway with dozens of doors. During the cheap money era, every door was open. Start a company, open. Buy real estate, open. Borrow to expand. Take huge risks, open. Chase every trend, open. The hallway felt like an endless invitation. Now some of those doors are closing, not all at once. One by one, softly at first, then firmly. And when people hear the sound of doors closing, their instinct is to sprint toward the remaining ones before they shut. But panic always leads to poor choices. The wiser move is different. Instead of sprinting, stand still. Watch which doors remain open. Watch which new ones appear. Watch which ones never should have been opened in the first place. A rising rate world doesn't eliminate opportunity. It reshapes opportunity. Suddenly, boring assets become attractive again. Suddenly, cash offers safety instead of drag. Suddenly, businesses with real earnings become valuable. Suddenly, slow and steady plans outperform dazzling gambles. This is the world many investors have never lived through, but it is a world your grandparents would recognize instantly. In that older world, money had weight, debt had consequences, savings had meaning, growth took time, wealth was built through consistency rather than speculation. People weren't rewarded for chasing every dream. They were rewarded for choosing a path and walking it long enough for compounding to show its power. We are not going back in time, but we are returning to principles that time once respected. The next part moves deeper into what individuals can do during a global shift like this, even if they feel small in the face of massive financial forces. When global liquidity shrinks, the world pretends the problem is technical. People talk about yields, balance sheets, currency flows, and central bank meetings. But beneath all of that, the real question is simple. What do ordinary people do when the financial tide goes out? The transcript warned that when money rushes back toward Japan, many investors worldwide may sell whatever they can to raise cash, creating shockwaves across markets. But for individuals, the impact shows up in three places long before the headlines catch up: in their debt, in their spending, and in their expectations. Debt becomes heavier, spending becomes sharper, expectations become smaller. This is not failure, this is adaptation. Every financial system eventually forces people to realign with reality. Some fight it, some deny it. But the people who strengthen through the shift are the ones who accept that the world has changed and adjust their behavior sooner than everyone else. This is where the opportunity lives. Opportunity doesn't appear when everything is rising. Opportunity appears when people finally see clearly. In an age of rising rates, clarity becomes its own form of capital. Clarity about what you can afford, clarity about what matters, clarity about the real purpose of money in your life, clarity about the difference between wants and obligations, clarity about the value of stability. The transcript described how interest rates across the world might recalibrate upward as Japan tightens its long grip on cheap liquidity. That recalibration affects every mortgage, every car loan, every credit card balance, every business loan, every student debt burden. But the people who thrive in cycles like this don't wait for lower rates. They build a life that works even when rates stay elevated for years. The key is to shift from relying on the environment to relying on your structure. Structure outlives conditions. A household with a clear budget can survive volatility. A household with manageable debt can withstand rising payments. A household with emergency savings can avoid desperation. A household that invests consistently can benefit from market corrections instead of fearing them. Structure is what keeps you upright when the wind changes. There's a moment in every tightening cycle when people realize they were living too close to the edge. Some panic, some freeze, but others quietly adjust. They trim what needs trimming. They slow what needs slowing. They build what needs building. These people are not pessimists. They are builders. Builders don't complain about the storm. Builders reinforce their foundation. When your foundation is strong, turbulence becomes opportunity. When your foundation is weak, even mild turbulence feels like disaster. This is the deeper message hiding behind every global shift. The world's stability is unpredictable, but your habits are not. You cannot control Tokyo or Washington or global liquidity flows, but you can control the 4 inches of space between your ears. That space determines your financial survival more than any central bank meeting. And in that space lives the most important question of this entire script. How do you behave when the rewards for patience become greater than the rewards for speed? Speed dominated the last decade. Patience will dominate the next one. During the cheap money era, impatience looked smart. People made fortunes by moving fast, taking risks, borrowing freely, and chasing every trend. But in a rising rate world, speed stops being an advantage. Slow becomes strong again. Quiet becomes powerful again. Consistency becomes rare again. Cash flow becomes king again. This shift can feel strange for anyone who grew up in the era of instant returns, but it is familiar to every generation before that. They built wealth slowly. They avoided unnecessary debt. They saved before they spent. They invested in things they understood. They valued endurance over excitement. And almost without knowing it, we are heading back toward a world where those old, simple principles feel like wisdom again. The next part of the script goes deeper into how investors can prepare for this transition, not through prediction, but through posture, the way you stand when the world leans. When the world enters a tightening cycle, investors often make the same mistake. They look outward instead of inward. They focus on forecasts, predictions, and expert opinions. They stare at charts and wait for signals. They hope someone else will tell them when the storm is over. But storms don't end on command. Storms end when the environment decides they're finished. The transcript described how Japan's policy decisions could ignite sharp movements in global markets, including sudden declines in tech stocks, cryptocurrencies, and other liquid assets as investors rush to cover obligations. That kind of volatility leads many people to freeze. They hold their breath, waiting for perfect clarity. But clarity doesn't come from watching the waves. Clarity comes from understanding how to stand on the shore. Your posture matters more than your predictions. Posture is how you prepare. Posture is how you respond. Posture is how you stay upright when everything around you tilts. A good posture in investing has 4 elements: enough cash to stay calm, enough patience to stay invested, enough humility to accept uncertainty, enough discipline to follow your plan when the world feels unstable. Most people underestimate cash. They think cash is boring, weak, or unproductive, but cash is the seatbelt of a financial life. When markets fall, cash gives you oxygen. It prevents panic. It buys time. It creates opportunity. It keeps you from selling assets you want to keep. A world with rising rates makes cash meaningful again. Cash is no longer a placeholder. Cash becomes a strategic asset. Patience becomes valuable too. Patience in a cheap money world felt unnecessary. You didn't need patience when everything rose by default. You needed speed. You needed boldness. You needed confidence. But now the conditions reward a different trait. Patience is no longer optional. Patience is profit. When money tightens, the timeline of returns stretches. Gains come slower. Recoveries take longer. Volatility lasts for months instead of weeks. Investors who cannot sit still feel punished, even when they're doing the right thing. But anyone who masters patience during a tightening cycle builds a skill that compounds long after the cycle ends. Humility is another part of posture. It keeps you from chasing trends simply because they rise quickly. It keeps you from believing you know the future. It keeps you grounded when others are swept up by fear or euphoria. Humility is not weakness. Humility is awareness. Awareness that the world is bigger than your opinions. Awareness that markets don't care about your hopes. Awareness that uncertainty is not a flaw, it's the normal state of things. And the final component is discipline. Discipline is what keeps your hands steady when the headlines are loud. Discipline is what keeps you contributing to your investments even when others are pulling back. Discipline is what prevents desperation. Discipline is what builds wealth when the environment is no longer generous. With those 4 traits, a tightening cycle becomes manageable, even beneficial. Without them, even calm markets feel dangerous. The transcript mentions something important. Markets can fall sharply for reasons that have nothing to do with fundamentals. Sometimes they fall simply because someone somewhere needs cash immediately. That means prices don't always reflect value. They often reflect pressure. Pressure can push great assets down. Pressure can create temporary bargains. Pressure can reward people who stay calm while everyone else rushes to the exits. This is why posture matters more than prediction. Prediction tries to time the storm. Posture prepares you to walk through the storm without losing yourself. There is a deeper psychological shift happening too. People are relearning the meaning of enough. Enough savings, enough buffer, enough stability, enough margin for error. When cheap money flowed freely, the idea of enough felt outdated. People wanted more growth, more leverage, more speed, more return. But when the environment tightens, enough becomes strength again. The people who thrive in this new chapter won't be the ones who take the biggest swings. They will be the ones who build carefully, consistently, and quietly. They will be the ones who allow compounding to work without interrupting it every time fear rises. They will be the ones who let time do the heavy lifting. The next part turns toward a deeper question. How do you build long-term wealth when the financial world around you is transitioning to an era of higher costs, slower growth, and greater uncertainty? Long-term wealth is not built in calm waters. It's built in confusing moments like this when the world feels uncertain and the ground feels uneven. These are the seasons that separate noise from signal, hype from value, confidence from clarity. The transcript warned that the age of cheap money is ending, and with it, the habits people built during that era will no longer work the same way. But this change is not the end of opportunity. It is the beginning of a different kind of opportunity, one that rewards depth instead of speed, thoughtfulness instead of impulse, intention instead of reaction. The first step is to rethink risk. Most people treat risk as a number on a chart, but risk is personal. Risk is how your heart behaves when your investments fall. Risk is how your mind behaves when you lose control. Risk is the distance between what you want and what you can emotionally tolerate. In the era of cheap money, people took risks they didn't understand because they never had to pay the bill for them. When the bill arrives, the world becomes honest again. And honesty is a foundation worth building on. The second step is to understand the power of optionality. Optionality is the ability to act when others can't. It comes from having savings. It comes from having a steady income. It comes from keeping your obligations light enough that you can move when opportunity appears. People underestimate how much money is made simply by being able to say yes when others are forced to say no. A tighter financial world makes optionality priceless. It gives ordinary people room to make extraordinary decisions. The third step is to embrace the long view. The long view is not a timeline, it's a posture. It's the willingness to hold steady while others panic. It's the ability to see a downturn as a seedbed instead of a graveyard. It's the understanding that real wealth is created quietly in moments when attention is focused elsewhere. Markets fall, markets recover, fear rises, fear fades, cycles tighten, cycles loosen, but time, when combined with consistency, tends to reward the patient far more than the restless. The fourth step is to build around things that will still matter a decade from now. Businesses with real earnings, skills that increase your earning power, relationships that open doors, habits that compound, assets that produce cash flow instead of consuming it. These are the pillars of long-term stability. They don't rise quickly, but they don't collapse quickly either. They form the kind of wealth that survives storms not because they are invincible, but because they were built with intention instead of excitement. The transcript highlighted how financial shocks can ripple through global markets, exposing weaknesses and forcing abrupt adjustments, but the deeper truth is that shocks don't create weakness, they reveal weakness, and once something is revealed, it can be rebuilt stronger than before. This is where the final and most important principle emerges. A changing world is not your enemy. A changing world is your teacher. It teaches you to be careful with debt. It teaches you to value liquidity. It teaches you to invest in skills, not trends. It teaches you that wealth is a byproduct of discipline, not luck. It teaches you that silence is often more profitable than noise. It teaches you that your financial future depends far more on how you behave than on what the market does. Most people believe wealth is built by finding the right moment. In truth, wealth is built by surviving every moment. Japan's shift may send waves across the world. Markets may shake, rates may rise, valuations may fall, headlines may scream, but beneath all of that, the same timeless principles remain. Spend less than you earn. Avoid unnecessary debt. Invest consistently. Keep cash for flexibility. Hold assets that endure. Stay calm when others lose balance. Give time enough time to work. The world is entering a new chapter, but the story of wealth has not changed. The tools have not changed. The principles have not changed. Only the environment has changed. And those who adapt to the new environment will build fortunes in the shadows while everyone else complains about the light. You are not powerless in this transition. You are not small. You are not at the mercy of distant institutions. You are the author of your financial life. And the choices you make in moments like this echo longer than the storms that surround them. A world with more expensive money is a world that rewards clarity, patience, and grounded thinking. This is your moment to build the foundation that the next decade will rest on. The tide is shifting. Stand steady, build wisely, move with intention, let time do the work,